Hello and welcome to our channel Finance Account in Simple Terms. Today we are going to talk about the three golden rules of accounting. Let's get started. Before we talk about the three golden rules of accounting, it is important to understand debit and credit. So, debit and credit are equal and opposite entries in your accounting books. They are always equal. They affect the five core types of account: asset, expenses, equity, liability, revenue. Debit increases an asset or expense and decreases equity, liability, or revenue accounts. Credit, on the other hand, do exactly the opposite. Credit increases equity or liability or revenue accounts and decreases asset or expense accounts. Now let's see golden rules. Rule number one: debit the receiver and credit the giver. This rule is applicable to all personal accounts. And what are those personal accounts? So, personal accounts are mainly self accounts, representative accounts, or artificial accounts. So, few examples like individual, legal entities, account receivable, accounts payable. In summary, rule number one is applicable to all parties. Rule number two: debit what comes in and credit what goes out. This rule is applicable to all real accounts. So, real accounts can be tangible real accounts and intangible real accounts. So tangible real accounts includes tangible assets like furniture, properties, cash, etc. Intangible real accounts include intangible assets like copyright, goodwill, trademark, etc. In summary, we can say rule number two is applicable to all assets. Rule number three: debit expenses and losses, credit income and gains. So rule number three is applicable to all nominal accounts. Let us understand what are these nominal accounts. So nominal accounts are income accounts like sales, revenue from services, consultancy fees, other income, etc., etc. On the expense side, similarly, purchases, professional fees, office expenses, staff welfare expenses, etc. are example of nominal accounts. So in summary, nominal accounts are applicable to all P&L items. So rule 3 is applicable to all P&L items. These last two accounts, real and nominal, also referred as impersonal accounts. Now let us understand these rules with the help of examples. Before we look into the examples, just one more thing which is very important, that rule number 1, 2, and 3 are applied together for a transaction, because in each transaction, either a party is involved, and along with that party, either a expense account or a income account or a asset account is involved. So rule number 1, 2, 3 are applied together. Now let's move to example 1. Mr. X purchased goods worth rupees 1000 from company ABC. In this scenario, you need to debit the purchase account as per rule 3. Debit all expenses and losses and credit the accounts payable account. Credit the giver. So you can see that purchase account debited with 1000 rupees and accounts payable is credited with 1000 rupees. In another example, Mr. X have sold goods of rupees 800 to company Alpha on credit and rupees 600 to Mr. B in cash. In this scenario, you need to debit the account receivable, debit the receiver as per rule 1, and cash account debit what comes in as per rule 2, which is a real account, and credit the sales account, credit income and gains as per rule 3, which is a nominal account. So it is a classic example of all rules together, and the general entry will look like this: cash account 600 debit, which is a real account, account receivable 800 debit, which is a personal account, sales account credit with 1400 rupees, which is a nominal account. Now let us see the balance sheet presentation of these transactions as well as P&L presentation. So in the asset side, we have account receivable of 800 rupees from example 2, cash of 600 rupees again from example 2, and in the income side, we have sales account with 1400 from example 2. In the asset side, sorry, in the liability sides now, we have accounts payable of 1000 rupees and purchase accounts in the P&L account on the expense side of 1000 rupees. Let's move to the next slide. Example 3. Company ABC purchases 50 chairs for 5000 in cash. So in this case, we are going to debit the furniture account by rupees 5000, which is a real account. So as per rule 2, we are supposed to debit what comes in, and on the credit side, we are going to credit the cash account by rupees 5000. That is also a real account, which refers to credit what goes out. So for both the transactions, rule 2 will be applicable. In the balance sheet presentation will be as follows. So please note this is a balance sheet extract. So therefore we have shown the cash account as negative and the furniture account with the same amount on the positive side. On the P&L, this transaction will have no impact. Example 4. Mr. X takes consultancy services for rupees 1000 from KMG Farm. In this transaction, we are going to debit the professional expenses by rupees 1000. So professional expenses are a P&L item which is a nominal account, and as per the rule we are supposed to debit the expenses and losses. And on the credit side, we are going to credit accounts payable with 1000 rupees, and the accounts payable is represents a personal account, and as per rule 1 we are supposed to credit the giver. Similarly, in example 5, we have exactly opposite scenario wherein Mr. X renders consultancy services to Mr. B for rupees 1500. In this case, we are going to do a exactly opposite entry by debiting the account receivable with rupees 1500, and this is done as per rule 1. Account receivable is a personal account, and as per rule 1 we are supposed to debit the receiver. And in the credit side, we have consultancy fees with the same amount. So consultancy fees is a P&L item and it is a nominal account. And for all nominal accounts, rule 3 is applicable, which says credit all income and gains. The balance sheet and P&L presentation of these transactions will look like as shown here. In the asset side, we have account receivable by rupees 1500 as per example 2, and on the income side in P&L we have consultancy fees with the same amount. And for example 4, in the balance sheet in the liability side we have accounts payable with 1000 rupees, and in the P&L account we have consultancy expenses on the expense side with 1000 rupees. So that's all for now. Thank you for watching. For question and clarification, please use comment section or email us. Please like this video and subscribe our channel for interesting financial topics understanding in simple terms. Thank you. Thank you so much.